Bom, é um prazer enorme estar aqui com vocês hoje. Muito obrigado pela presença de vocês. Naquilo que eu acho que vai ser um painel, talvez dos painéis mais interessantes dessa Expert, né? O tema não podia ser o tema mais atual, né? O que vai acontecer com o mundo, o que vai acontecer com política monetária, e a gente não podia ter uma pessoa melhor para falar disso, né, Alberto?
Sí, voy a cambiar a inglés para también presentar al Dr. Lawrence Summers. So thank you very much for being with us. It's a pleasure to have you this morning again, the second day of Expert. And today we start with a very relevant invitee. To me, Professor Lawrence Summers is perhaps a legend in economics, one of the most relevant economists of the time. Professor Summers, Secretary Summers as well, he was the Ministro de Fazenda in the past. He was also Undersecretary. He was also the head of the World Bank for a while, and he has been involved in many emerging market crises, and he has been basically around for a very long time. And we have the pleasure of having him today. And he was also, by the way, president of Harvard University for a while, and lately he has been traveling the world and giving his opinions about economics, about politics, etc. So for us, it's a pleasure and an honor to introduce Professor Summers.
So, starting with the easy question, Professor Summers, your April 2022 NBIR paper makes the following logic, right? We have a very tight labor market. Very tight labor markets lead to high wage inflation. High wage inflation is associated with a recession, usually in a 2-year time frame, right? It also suggests that in order to contain inflation, it's necessary to build a substantial amount of slack in the economy, right? This seems somewhat at odds with the market view of a somewhat shallow recession, right? I mean, could you elaborate on the views that is presented on your paper and what can we expect from that?
Let me just first say how glad I am to be here. I think this is a really important event. I think what you do at XP is very, very important. I like to call it the people's capitalism. Finance should not just be about some elites giving money to other elites. It should be about everybody benefiting from the investment opportunities in our society, and every entrepreneur having as much access to capital as their projects can really justify it. So I think this kind of conference and what your firm represents is something that's very, very important. Look, I think we're in a not easy moment in financial policy around the world and in inflation policy in the United States. I always used to think that the idea was that Latin America would become more like North America. Sometimes, looking at Donald Trump, looking at the acceleration in our inflation, looking at increasingly nationalist trade policies, looking at some problematic corporatism, I wonder whether the United States is becoming more like Latin America. I think the evidence is that, as George Bernard Shaw said in a different context, soft landings represent the triumph of hope over experience. And that the most likely thing is that we will not, given how high inflation has gotten, given how overheated the economy is, that we will not have a soft landing. And so I think a recession in the United States and a recession in Europe, with consequences for the global economy, especially given everything that's happening in China, are quite likely. But I think the biggest mistake would be to not recognize that we have created an inflation problem and we have to work through that inflation. I would guess almost everyone in this room has made the following mistake. The doctor gave them a prescription, they took the prescription, they felt better, but they didn't take the whole course of antibiotics that had been prescribed, and then the bug grew back better and grew back stronger. And that's, I think, a real risk in the current situation. So my hope would be that the Fed will do what's necessary to put the inflation genie back in the bottle for another 40 years. I think that's likely to be rather more tightening than is now priced in. And unfortunately, I think it's not going to happen without some kind of economic downturn. Not, to be sure, the kind of downturn that we had when the pandemic struck, not the kind of downturn we had with the great financial crisis, not the kind of downturn that Paul Volcker was forced to engineer in 1982, but a significant and serious downturn nonetheless, perhaps with unemployment exceeding 6%.
Professor Summers, I have a very good friend here in Brazil, and we talk all the time, and he asked me a couple of months ago, and he said, "Hey Alberto, what was the best trade in Brazil during 2021? And I said something, I don't know, I said, I don't know, fixed income or something. They didn't have the numbers in front of me. And he said, no, Alberto, the best trade of 2021 was a 2-year-old Volkswagen Gol, which went up 55% in price. Second-hand cars went up in price. And then I started checking because actually my 16-year-old started driving, so I was looking for a second-hand car in the United States. And I checked the numbers. Turns out that probably the best trade in the United States was a Jeep Wrangler, 2-year-old Jeep Wrangler with 20,000 miles. Because there were no cars at that point in time. And we're still pretty much down. They published 2 days ago that the US is only selling 13.5 million cars per year on an annualized basis when it used to sell 17 million. Now, as an analyst, as an economist, I said, this is not sustainable, this makes no sense. So I made the mistake of actually thinking that inflation was transitory. So I have a kind of like a mea culpa on this whole thing. But when I speak to clients, they keep on asking me the same issue. It's like, Bernal, give me your hypothetical. Is there any way that if goods inflation starts to fall very fast, will it make up for the structural parts of inflation, housing, labor, et cetera, and could we get a good end scenario like the market is forecasting, or in your view, this is just wishful thinking?
I'd say 3 things. First, someone who is very senior at a firm that is as successful as XP should enable your son to drive a car that's better than a second-hand Volkswagen. And I feel that very strongly on behalf of your son. Second, it is almost always a mistake to think about inflation on a product-by-product basis. You're right, there was all kinds of stuff going on that was semiconductors and so forth that was reducing the demand for cars, and that contributes to the increase in the price of used cars. But of course, if people have to spend more buying cars, they have less money to spend on other things, and that makes the price of those other things go down in value. So I think it's usually better to look at total volumes of spending. And if you look at total volumes of spending in the United States, nominal GDP spending has increased at a rate of nearly 9% over the last 18 months. And that kind of makes excessive inflation almost inevitable. So I think usually when you start doing a product by product analysis, you're going to get yourself confused. I mean, a classic metaphor, which was Arthur Oaken's, is if you're at a football game and one person stands up, they see better. If everybody stands up, nobody sees better. So thinking about the micro and just extrapolating to the macro goes wrong. Third thing I would say is, look, the answer to all questions in economics, is it possible that, is yes. The answer to all questions in economics of the form, should we be concerned about Z, is yes. But if you ask me about probabilities, do I think that oil prices, which have come down by 25%, are more likely to go up in a geopolitically unstable world or go down? I think they're probably more likely to go up. Do I think that grain prices, which for reasons people don't very fully understand, have come down significantly? Which way do I think their next move will be? I suspect probably upwards. If I look at what's happening to the level of wages, I think of that as a kind of core inflation concept. And when wage inflation is accelerating and labor markets are tight, it doesn't feel to me like inflation is going to go away entirely on its own. So it could be that Team Transitory should have called itself Team Long but Temporary, and that it will turn out to be vindicated. That's a possibility, but it would not, in my view, be a probability. And I think the better bet would be that we don't get out of this without a recession.
Professor Summers, switching to the world, we've seen in the onset of the COVID crisis kind of coordinated monetary policy, right? Everyone just basically dropped to zero and tried to inflate away the problem. Now that we are emerging out of the crisis, there are divergent monetary policies, right? The U.S., albeit at its pace, seems to be at the forefront. The ECB has several structural problems to deal with. The BOJ is with yield curve targeting and doesn't seem to be yielding out of that, right? So how should we think about this world where monetary policies start to diverge from now on?
It's not an accident that the dollar is very strong. It's a wisecrack, and it's not a fair wisecrack, but it's got an element of truth to say that the dollar is fortunate in its alternatives. Europe is a museum, Japan is a nursing home, China is a jail, and Bitcoin is an experiment. And that tends to support the value of the dollar. If you look carefully at inflation in the United States versus in Europe, it sure looks like it's much more overheating in the United States than it is in Europe. Core measures, wage measures are much higher. The United States has the benefit of being essentially independent in natural resources and fossil fuels and food. Europe very much is not. And so it stands to reason that US monetary policy, in the face of a more purely demand inflation, would be tighter than European monetary policy, even before you get to the issues of keeping the monetary union together. Japan, I think, is in a somewhat different place because of really profound implications of deeply depressed demography and a substantially shrinking labor force with no capacity to accept innovation or immigration or for that matter, not a lot of capacity to accept innovation. So my guess is divergent monetary policies will be with us for some time, that the dollar will continue to look strong, but I think that's kind of the benefit of the flexible exchange rate system we have, that it enables different countries with different needs to pursue different monetary policies.
Following on your analogy, which I love in terms of soft landings and second marriages, way before I used to work for a bank called Bear Stearns. And I think one of the biggest mistakes I ever made as an analyst, I made it on August 17 at 3:35 in the afternoon in an auditorium in Mexico City, which just showed a graph of the 2-10 relationship, 2-year bond against the 10-year bond. For those of you in the audience that don't know this model, whenever the 2-year bond yields more than the 10-year bond in the United States, usually 6, 12, 15 months after, we get a recession. So on March 15, 2000, I actually said, this is the first time in the history of humanity that this model is not going to work. Why? Because Bear Stearns was flying and we making so much money. Zero humility from my side. March 15, 2008, 8 in the morning, it's a Friday. I call my wife and I say, hey honey, I got 2 pieces of news, a good one and a bad one. Which one you want to hear first? And she says, the good one. I say, well, the good one is that I'm coming home early. The bad one is that Bear Stearns just collapsed. So we have no idea how the hell we're gonna pay for the kids' schools and everything. The curve inverted 3 months ago, and it's quite inverted today. And at the same time, I don't think this has ever happened. We have 1.7 job openings for each person unemployed. If we get into a recession, from your knowledge, this would be the first time in the history of the United States that we get into a recession with such a strong labor market, right?
I'm with you in part on that analysis. By the way, it seems to me you've got a wife with a very good sense of humor. I hope you get her a nicer car than you get your son. I wouldn't quite go, I don't think I'd quite go to where you went. Look, the reason why an inverted yield curve is a predictor of recessions is not because an inverted yield curve causes a recession. It's because an inverted yield curve reflects the fact that the market's judgment is that the central bank is going to bring interest rates down substantially. And the only reason central banks bring interest rates down substantially is because there is a recession, and markets are right more often than they're wrong. So it's important to understand it's not like by changing the curve you can change the economy. The curve, that's like saying that by putting a different score on the scoreboard you can change the outcome of the football game. The outcome of the football game is what it is. The outcome of the economy is what it is. I think there are 2 ways of taking our very strong labor market right now. One is we're somehow impregnable and not going to have a recession. And the other is the higher you are, the harder you fall. And I think that it's actually easier for unemployment to go up from 3.6 than it is for unemployment to go up from 5. I think it's easier to go down from 10.5 million vacancies than it is to 7 million vacancies. So I think I would describe our economy as, to use a rather uneconomist-like term, I would describe our economy as cruising for a bruising. That when you've got very high inflation and you've got a super tight labor market, it just seems like things can only go one way, and that is towards a less tight labor market as part of bringing inflation down. So I'm could obviously be wrong, but I'm reasonably confident we'll have a recession within the next 18 months. What I'm less confident about is how much central bank action it will take to generate that recession. So how high rates will have to go before we get it, and how long it will last, because I'm not sure how long the central bank will continue. I mean, it's easy to believe and be committed to what the central bank now believes. What the central bank of the United States now believes, as judged by its statements and as judged by its forecasts, is that it is going to succeed in eliminating inflation, and it's going to succeed in eliminating inflation back to 2% without ever raising the Fed funds rate above 3.25%, and that it's going to do that without the unemployment rate ever getting above 4.1%. That's what the central bank believes, and given that they believe that, how could they not believe they're going to do everything that's necessary to reduce inflation? I saw that you all are going to have the privilege of being with Serena Williams later in your conference. Well, I could believe that I was going to play tennis with Serena Williams and that I was going to win 3 games. I could believe that, and it would make me feel very happy to believe that. It wouldn't be a belief that was rooted in reality. And I think the view that the Fed is going to get inflation down without getting interest rates up very substantially, and without there being any kind of downturn, could happen, but I'm not sure what in economic history or in economic theory would support that view.
Following that logic, Professor, some economists that even consider the view of a shallow recession, they said, look, the US households are in decent shape, they're in good shape, the US corporate sector is in decent shape, financial institutions are much better than they were in 2008, therefore, shallow recession. Couldn't we invert the logic and say, look, that actually diminishes the sensitivity of the US economy to rate hikes, and therefore more rate hikes are needed? Does that make sense?
Yes. Look, I think if you think the reason we are having a recession is that it's a necessary part of the process to bring down inflation, then if the economy is more resistant to recession, you have to hit the brakes harder. If the car has a more powerful momentum and a more powerful engine, then you have to make a larger gear shift to slow the car down. If the car is very heavy, you have to push the brakes harder to get the car slowed down. So while many people make the kind of argument that you just made, household balance sheets are healthy, the banking system is well capitalized, as an argument for believing that we're not going to have significant recession, I read it very differently. I read it as you apparently do, as an indication that interest rates are going to have to go up higher than they otherwise would.
Professor Summers, one of the questions that I get the most from our institutional clients, every time we start talking about China, US, world economy, etc., it always comes back to that. Is it, Bernal, is the Fed willing to do whatever it takes to fix this problem? Is the Fed going to be, is Powell going to be able to become Volcker in terms of what he needs to do? And the reason why I ask you this is because the world has changed. When I was much younger, I would look at the central bank meetings in Congress, for example, and it was pretty much focused about economics and inflation and rules, etc. I was watching the other day, and Bob Menendez asked Powell, so Chairman Powell, what are you doing to make sure that somebody with a Hispanic last name is a member of the committee? It was like, I mean, Powell was very lukewarm in his answer. He said, well, we're trying the best we can, but what the hell can Powell do to make sure that somebody like Bernal gets to be part of the Open Market Committee? That's my job, that's his job. The same thing with climate change. What are you doing about climate change? What can't the Fed really do about climate change? That woke mentality that has been taking over central bankers, which makes everything more difficult. So the key question I get is, will they be able from a political standpoint to do this? Or if you were going to advise my clients, would you say, you know, it is what it is, the world has changed, we're going to have to co-live with 3.5% inflation for 4 years and not go back to 2%?
You know, sometimes people ask me whether a child of mine or a relative of mine or the child of a friend of mine is going to marry their current partner or is going to take some step. And often I find myself answering by saying, I can't know because they don't know. And the one thing that you can be pretty sure of is you can't predict what people are going to do if they don't even know what they're going to do. And I don't think anybody can have complete confidence in where the central bank is going to go. I think if you followed what the Fed said over the 2 years between 2019 and 2020 and 2021, I think it would be fair to say that it was the woke, we care Fed. They were talking about not just overall unemployment, but group by group unemployment. They were talking about the environment. They were talking about the income distribution. They were talking about almost anything except for price stability, and when they talked about price stability, they were mostly talking about avoiding deflation. And that was the mode that they were in. I think if you go to what's been the case since, say, last November or December, it's been more, please God, let us not be Arthur Burns. Please God, let us not be remembered like the people in the 1970s were remembered. And that's a very different gestalt. That's a gestalt that says, err on the side of preventing inflation, persevere, all of that. And I think that's how they feel right now, and that's what they are saying. I think they are still in denial, as I mentioned a moment ago, about what the price of that is. I think they are happy to pay the price of 4% unemployment. They're probably happy to pay the price of 4.5% unemployment. They might well be happy to pay the price of 5% unemployment to push inflation out of the system. But if, as I suspect, it takes much more than that, then it's going to be a much more difficult set of judgments. And that's why I think there is both stagflation risk and significant recession risk. And I think the less recession we have, the less recession we have over the next 18 months, the more stagflation risk we're running for 2 or 3 years from now. Look, none of this should be hugely new to the people who are listening to us. These stories are the stories of the Latin American macroeconomic experience over the last 50 years. And it's a story of alternating policies. It's a story of complex politics. surrounding the relationship between central banks and governments. It's a story of trying to seize on ways of thinking about inflation that run through particular products rather than go through overall price levels. And so, and it's a story of less than complete credibility. And you know, the one thing we know about credibility in monetary policy is kind of the same thing we know about it in eating. It's basically easier to keep control than it is to lose control and get it back.
On that topic, I mean, we've been somewhat surprised by the communication from the Fed, right? When the chairman stands up and said, look, we are neutral, right, with inflation running at 9, and communication being such an important tool at the disposal of a central banker, I mean, it's been somewhat surprising, right, to see, because it seems to be that you're doing a disservice to your objective of anchoring inflation expectations. What would you say about that?
Well, what I did say 2 days after he said it on Bloomberg television was that the judgment was analytically indefensible, which I don't think left enormous room for ambiguity as to how I felt. I suppose the argument would be that the 9% inflation is a backward-looking CPI, and that if you looked at inflation on some forward-looking measure, you could get some significantly lower number. And I suppose the argument would be that for the reasons I talked about when I talked about secular stagnation, that the real interest rate might be lower, neutral real interest rate might be lower, so that would make the neutral nominal rate lower. But I was very surprised when I heard the chairman of the Fed say that. I think one of the interesting things is that in the period since he said that, break-even inflations have gone up, and index bond yields, measures of real yields, have gone down. So in some sense, monetary policy has become more expansionary, and I'm not sure what the theory would have been to justify a net set of steps that were loosening in the wake of what had happened, in the wake of what's happened with the inflation statistics.
Shifting gears a little bit to another very relevant section of the world, which is Europe. So I did my master's I believe you taught there once, at the Kiel Institute of World Economics in Kiel. So for those of you that haven't been to Kiel, go some other place before, because there's not much else to see in that city. But the whole point is that I keep on being involved with Germany because of the fact that I lived there for a while. And I was reading the newspaper a week ago, and apparently—
Just a second, I am sure that just as if you go study at Cambridge, you can go see the dorm room that Keynes lived in. I'm sure at Kiel that they have preserved as a museum exhibit the place where you lived, given your contributions to economics.
From Professor Schubert, I think that was the head of the institute. But here's the thing: Germany has a contingency plan to heat homes with wood during this winter, because winter is coming. I mean, if Russia gets really aggressive and completely stops the flow of gas, Germany is thinking about cutting trees to keep people from freezing. It's just crazy. I would have never thought that would ever happen while I was alive, but here we are. So the issue, what I mentioned to you, is that if you were to analyze the world economy going into the year end, and you have this contingency, what would you tell our clients, our investors, to how should they address this possible tail risk? Because I do think it's a tail risk, but in terms of advancing some kind of portfolio formation, or how worried are you about Europe really falling into a major depression, for lack of a better word?
I have two sets of views that don't juxtapose very well. On the one hand, I'm very alarmed about what's going to happen in Europe. I think there are enormous difficulties in the Ukraine conflict. I think that conflicts like this tend to surprise more by how long they last than by how quickly they end. I'm always reminded that on both sides, in Britain and in Germany, the only thing they agreed on was that the war would be over before Christmas of 1914, and it only barely ended before Christmas of 1918. So I share the sense of alarm. But I think I would say something else, and I think it's an important lesson. And that is that more money has been lost missing rallies than has been saved avoiding downdrafts. And that is a very deep lesson of financial history. That people become alarmed, but often by the time they've become alarmed, a fair amount of their alarm is already priced into markets. That when one pulls money out of markets, it is very difficult to figure out when to move it back. Usually when you pull money out of markets, when they're down, it seems like, well, I pulled it out because I was worried and they're down even more now, so I guess I should be even more worried now than I was then. So it's hard to put money back when it's still down, and so people often wait until they feel good, which is when the market's up 20 or 25%, at which point they've missed a significant part of the gain. So I think my general advice would be try to understand what's going on, try to adjust portfolios at the margin, but I would be careful about getting oneself scared and pulling all one's money to the sidelines, because I think that often in the long run proves to be a very expensive strategy.
Professor, changing subjects a little bit, there's a growing debate in the US about the excessive power of technology companies and how should we regulate that. And I think I've seen some of your comments that you refer to as hipster antitrust. I mean, could you comment on that a little bit, please?
Yeah, look, I'm a big believer in antitrust. I don't like monopolies, but I think the right standard is a standard that's about economics, that's about consumer welfare, that's about low prices, good products, high variety for consumers. And that's how we should make antitrust decisions. And when I've disparaged certain ideas, it's not been because they were pro-antitrust, it's been because they were moving outside the idea of consumers as the prism for looking at antitrust. So I think that's how we should look at antitrust. I also think that antitrust captures only a small and probably not the most important part of the issues that are posed by technology companies. I'm not that worried if Amazon produces store brand ketchup that has an Amazon label on it. But I am worried if fake news saying that the 2020 election results are bogus is being read across the country by impressionable teenagers. I am worried about the pervasive availability of pornography on the internet. I am worried about the inadequacy of the controls on what 10-year-olds can see and entertain themselves with on various social media platforms. So I think we do need, in everything, we need a regulatory system that is as modern as the markets. And we still have a regulatory set of constructs and legal theories that date from the moments when the fax machine was a cutting-edge technology. And so I think we do need some kind of regulatory overhaul.
Bringing it home a little bit to Latin America from your experience when you were at the World Bank and when you were under secretary, I believe you managed the peso crisis in 1994 in Mexico. That must have been quite an exercise. But let me frame the question this way. I think it was 2 weeks ago in New York, took an Uber from 55th and 46th and 55 West 46th Street, which is 5th and 6th, 5th and 46th, all the way to JFK. That Uber was $120, and it's just ridiculous. I took a cab this morning from a hotel here to the Expo Center. It was $5 in this country. So Brazil is dirt cheap for people who are making dollars, and the U.S. is becoming ridiculously expensive for people, earning in reais. But at some point, and that's what, at least from my understanding of historical precedents and empirical evidence on this issue, real exchange rates tend to be mean reverting. So, from your view, and with that kind of environment, if you were to make a call on the next 10 years of this region in terms of value of assets in this place, I'm talking about Colombia, Peru, Chile, Brazil, etc. From your experience during the World Bank and the way that crises happened in the past, are you a bull or a bear case for the region?
Three things to say. First, it's even worse than that, than you describe, in the sense that yields here are much higher than yields in the United States, including real yields. So markets are pricing in that gap you described is going to get greater, not get smaller over time. So the market's betting on that trend. If you think it's going to stay the same, then real assets are much more attractive than dollar assets. Be the first thing I'd say. Second, I think that a ton of it is going to depend on governance and the quality of institutions. Look, your country, Brazil, was the most rapidly growing country on planet Earth for the full century from 1880 to 1980. That speaks to the entrepreneurship of your people. That speaks to the quality of your natural resources. That speaks to the work ethic and capacity for hard work of a large number of people in Brazil. It speaks to the kind of opportunity that is here. I think the question is actually one of political economy, and it's going to be, is the society going to get out of its own way? Is it going to figure out how to get all the children decently educated? Is the government going to reduce its presence in capital and credit markets to the point where good businesses are able to attract capital at prices where they can succeed? Are you going to have pension and public institutions that are going to be properly supportive of growth? I don't think there's any question that the potential is there for substantial convergence, and to be brutally honest, I think some of the mistakes that we're making are raising the prospects of your convergence. But it's not something that's going to happen automatically, and it's not something that's going to happen as a consequence of complaint.
Well, Professor Summers, it's been an honor to have you here. I mean, we could go on forever. We've learned so much. Unfortunately, I think we're running out of time, but I'd like to leave you with some room for final remarks. What would you say to our audience here?
I guess I would say thank you for having come and heard me. Thank you on behalf of the entrepreneurs, businesses, employees, infrastructure creators, corporations who are never going to know your names, but are going to be enabled to do important things by the investments that you make. But the question for our hemisphere for the next decade is Latin America going to get more like North America, or is North America going to get more like Latin America? And which way is that movement going to go? And everything you do to make your democracy be more one of government for the people as well as government by the people will be doing something that I think is profoundly important.
Professor Summers, it was an honor. Thank you very much. Thank you very much.
Thank you very much, sir.